The Trump reflation trade is deflating, but not completely empty. We'll have a quick look at where inflation and interest rates are trending and the latest feedback from our Reserve Bank. Plus the improved outlook in Europe. It's a fascinating start to the last quarter of the financial year. No change from the RBA again, as universally expected, and consistent with the flat view on rates for the rest of 2017. Although, more recently, thoughts of any RBA rate increases have receded as macroprudential policies are pushing up bank lending rates for investor lending. With the Australian property market in the spotlight and the RBA and APRA doing their best to avert a housing bubble, or at least minimise these risks, the recent increases in rates do leave the RBA in a holding pattern. Why cut rates in an overheated property market, but equally, why increase them with the latest round of enforced higher lending rates? We'll keep a close eye on property prices to keep you updated, and in particular in the most overheated areas in Sydney and Melbourne. As RBA Governor Philip Lowe noted earlier this week, housing-related debt outstandings have increased 6.5% in the last 12 months, while household income has only risen 3% over this time. Meanwhile, the trend earlier in the year, where stock markets were rising despite expectations of higher inflation and higher rates, has levelled off. Not so much here in Australia, where we're only around 100 points from the post-GFC high, but more so in the US, where despite their economy still appearing strong, there are doubts about President Trump's ability to deliver on his aggressive tax cuts. The path through Congress will be a difficult one if the failure to repeal Obamacare is any guide. We still expect 3 to 4 rate hikes this year in the US, but the impact on global reflation is still tenuous. Europe, and in particular Germany, meanwhile, is enjoying better economic data, but inflation there is remaining low. Earlier this week, we heard noises from the EU that they might start tapering their QE stimulus next year. And the latest German manufacturing and services index did just hit a 15-month high. All very encouraging, together with confidence that Marine Le Pen's anti-EU far-right party are well behind the moderates in France. Back home, the latest retail sales and consumer confidence numbers have been pretty underwhelming. So with wages growth stagnant, the risk in real estate investment is topic of the month, despite high auction clearance rates and relentless rises in house prices. The markets themselves aren't volatile, for example the very stable Aussie dollar, but confidence does seem ethereal, as geopolitical risks are ever present. At least the Chinese economy still seems in good shape, which is so crucial for our outlook. And finally, the effects of catastrophic Cyclone Debbie beyond the human toll will be seen in slower June quarter growth but slightly higher inflation, which again suggests official rates will remain on hold and it will be cautious trading ahead. Until next time, that's the market update from Bendigo Bank.